Hello, and welcome to the one and only channel on YouTube dedicated to educating the viewers on how to improve financial literacy. This video provides a synopsis of Michael Batnick's book, Big Mistakes, highlighting the book's 5 most important lessons. If you learn from these people's mistakes and remember their ultimate aims, you might expect to see similar success in the markets. To get updates whenever videos similar to those currently available are posted, please click the bell symbol and the subscribe button. We make major errors in the market simply because we aren't hardwired for it, but we have plenty of company. Superstar investors such as Warren Buffett, Bill Ackman, Stanley Druckenmiller, and Benjamin Graham may seem alien to the average investor due to their outsized fortunes, yet they are much like the rest of us in many ways. 4 legendary investors, including Mark Twain, share their worst investment decisions in this educational video. One reason for revealing this is to help you avoid making the same errors in your own portfolio. Nevertheless, the primary motivation is to demonstrate that blunders are inevitable. Amazing long-term market returns were achieved by Warren Buffett, Bill Ackman, Stanley Druckenmiller, and Benjamin Graham, thanks to their ability to learn from their mistakes and maintain focus on the big picture despite the inevitable setbacks. This is a short synopsis of Michael Batnick's book, Big Mistakes, focusing on the 5 most important lessons to be learned from it. Lesson number 1. The availability heuristic, as applied by Warren Buffett. Perhaps no investor has ever been as successful than Warren Buffett. He and his trusted advisor, Charlie Munger, founded Berkshire Hathaway, the world's biggest company. They got there by making smart investments in businesses over many decades. Yet, even investment legends like Warren Buffett have bad years. The availability heuristic is a cognitive bias that evolves favoring the first set of relevant examples that come to mind while assessing a problem. Warren Buffett identified a business in a sector where he had found past success, recognized that it was led by competent executives, and determined that it could be bought at a reasonable cost. It's no surprise that this is seen to be a wise investment. The takeaway from this is simple. You should exercise additional caution before putting your money into a company that seems comparable to one in which you had great success in the past. It's just the first takeaway, and it's dropping fast like a bomb. Well, continue watching this video for more, and don't forget to like and subscribe. Lesson number 2. The Law of Holes and Mark Twain. Mark Twain was a fantastic writer whose works on Tom Sawyer and Huckleberry Finn are now considered classics. Mark Twain only had one financial problem. For every book he sold, he lost money on an investment. Twain disregarded the law of holes by continuing to invest in a losing venture. Exactly what is the role of holes? If there be one, it's this. If you ever find yourself in a hole, it's best to stop digging. Substantially, if a stock is already becoming cheaper, it doesn't mean it can't become even cheaper in the future. The tough part is accepting defeat before it's too late. From this, what can we take away? Prior to making any stock purchases, you should establish a loss tolerance, either as a percentage of your whole investment or a fixed dollar amount. It's far less of a hassle to call it quits before you completely sink your finances this way. Third, consider what we learn about ego and Bill Ackman. Bill Ackman has become one of the most well-known and influential activists in the history of investing. An activist investor is one who utilizes his shareholding to influence decision-making at a corporation. A common scenario is a business with substantial assets but a declining revenue stream. Instead of continuing to pour good money after bad, an activist may push for a sale of a company's assets so that shareholders can pay out. Ackman refused to budge despite mounting data that disapproved his premise. What should we take away from this? The goal of investment is profit, not validation of our beliefs. That's why it's important to think twice before sharing any thoughts about the stock market. It might put you in a position where your pride prevents you from making the rational choice when it comes to your money. Share your thoughts below. Also, subscribe to this channel for more lessons to learn in investing and finances. Click on the notification bell too for notifications whenever there's a new upload. Observation number 4. Stanley Druckenmiller in Customized Investment Strategies. Stanley Druckenmiller is widely regarded as one of the most successful macroeconomic investor of all time, and his hedge fund generated average yearly returns of over 30% for its clients between 1981 and 2010. That's an impressive track record in the stock market. Even though Stanley Druckenmiller oversaw George Soros' Quantum Fund from 1988 to 2000, he nonetheless made several poor financial decisions. By using a global strategy and placing bets on stocks, bonds, and currencies, Druckenmiller amassed an extraordinary track record as an investor. The error is easily seen. One must not go too deep into the unknown. You need to stick to what you know and pick an investment strategy that feels comfortable. Despite his expertise as a macro investor, Druckenmiller dabbled in the IT industry at a time when it was so lucrative that even he couldn't resist the temptation to try it for himself. There may be periods when other investors are outperforming you financially, but that is to be expected and is not a reflection on your investment strategy. Benjamin Graham in Leverage is the fifth and last lesson to be learned. Last but not the least, sure, even Benjamin Graham, the father of value investing, made blunders in his day. Benjamin Graham is well known for teaching the aforementioned Warren Buffett and penning the book The Intelligent Investor. Graham's error was that he risked everything just before the Great Depression hit. The takeaway here is that investors need to build portfolios that allow them to participate in a bull market's gain while yet protecting them during a bear market's inevitable period of mass hysteria. And that wraps things up. Keep in mind that the great individuals develop and improve from their errors, while the average ones fall farther behind because of them. And that ends our video for today. If you found it helpful, please give it a thumbs up. And please share your ideas with me in the comment section. I'm interested in what you have to say. Having said that, make sure you subscribe and enable notifications so that you will be notified whenever we upload a new video. See you in the next one!